Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. A week or so ago, we wrote about historical precedents with respect to equity market returns amid war. The summary? Equities tend to decline in the prelude to war and rise when the first shots are fired. When we have seen divergence from that historical pattern, it's because there was simply no prelude. Between 1914 and 1918, the period that defines World War I, and between 1939 and 1945, defining World War II, the Dow Jones rose 8.7% and 7% per annum, respectively. During the two periods that arguably define the worst military conflicts in modern history, the markets rose. Most conflicts since then have been relatively short-lived. Have a look at this table courtesy of LPL Financial. It reveals past market performance following major geopolitical or historical events since World War II. Now feel free to pause the video to study the data. The bottom line is this: in the absence of a recession, the market appears to eventually shrug off conflict. Of course, none of this is to diminish the very real horror of the humanitarian crisis unfolding in the Ukraine, the mounting loss of life, and thousands of families and individuals displaced as they leave their homes and relationships for the safety across the border. For each conflict or crisis, investor uncertainty stems from the presence of elements that make it unique and worse than those that preceded it. With respect to Russia's unprovoked invasion of the Ukraine, we have, according to various press reports, an unhinged kleptocrat with a finger on a phalanx of nuclear weapons. Maybe this time is indeed different. And let's not forget investors were already nervous about inflation and rising interest rates before Putin's aggression. Indeed, the prevailing inflationary climate may have had something to do with his timing. Booming logistics has created an energy crisis, driving oil from negative prices just under 2 years ago to nearly $100 a barrel today. Commodity prices have also soared. US inflation hit a 4-decade high, and perhaps Putin seized the opportunity, thinking the West might be loath to impose sanctions that drive prices even higher. But the Ukraine is one of the world's largest exporters of iron ore, and some 600 million people in Europe and elsewhere are fed by the country's agricultural sector. Conceivably, Putin underestimated the West's determination to secure this important source of foodstuffs and mineral commodities. But more important than letting commodity supply fall under Putin's control, maybe it's the West's determination to defend democracy that he has completely underestimated. In just 4 days since the invasion began, the West has coordinated an unprecedented political, strategic, economic, and corporate response. Keep in mind the stock market can remain elevated for some time, even as a train wreck is obviously approaching. Eventually, however, it succumbs to a wave of panicked selling, much as a deer or rabbit transfixed by headlights succumbs to the vehicle careening towards it. Investors need to watch for the point at which the Allies' words, sanctions, and the supply of arms to Ukrainian civilians becomes inadequate to defend democracy and the Ukraine. Putin's persistence, and it's clear his pride won't tolerate anything less, and the failure of diplomacy would be a negative for risk assets. A consequent delaying by central banks, however, of both quantitative tapering and interest rate increases would be a positive. If diplomacy does succeed, the focus will return to inflation, interest rates, and the risk of a wage price spiral. In either case, the possibility of a pronounced correction is one investors should be ready to take advantage of. If I was to make one prediction, it's this: that in several years' time, we will have seen a correction, but we will also have seen peak inflation and the effect of automation on productivity and wages, which will be incredibly positive for high-quality businesses, those with pricing power, and those growing into their potential to be a multiple of their current size. That's all for now, and look forward to updating you again. Please continue to follow us on Facebook and Twitter in the meantime.